high. Morning, critical week this one. I mean, not just Fed, you've got a lot of central banks across the world due for their policy meet. But what is it that one can expect from the Fed?
Well, so, last week you had the ECB cut and Fed meeting on our decision will come out on Wednesday. Right now, the market is assigning, a 60% probability that they go 50 basis points. So, it's a toss-up right now between a 25 and a 50 with a slight increased emphasis on 50. My personal view is that they should do 50 just to be safe, just in case, they want to buy insurance. But given the proximity to the election, they might take a more prudent kind of not to be seen as being, tipping the scales one way or the other into 25. So it's a very finely poised. But my assumption is it's either going to be a 25 with a very dovish press conference by Chairman Powell after that, or it's going to be a 50. But either way, the path is well set. And, there's a pretty close to zero probability that they do nothing. So it's now just, a question of what's coming. And, as you guys were discussing earlier, I think clearly that means that, the market is, it's possible it does only 25 and the market gets a little bit disappointed, but the path trajectory is clear and it's just a question of pace now.
So Arvind, is 25 better than 50? That was the narrative for financials market last week, that if Fed actually hints at 25 and not 50, it means that they are not worried about the underlying growth, and that dismisses the possibility of a tough landing for US economy.
I don't read it that way. I read it that, there's a concern growing among some that they are behind the curve. And that, they've kept rates tight for so long. It's better to buy insurance early just to make sure that they offset the risk. So it's not like the Fed knows anything. But, one concern could be if they're doing 50, maybe they know something. The other explanation, which is the one I prefer, is that they're doing 50 just to make sure that whatever signs of softening we've seen don't become entrenched. And I think that latter is probably where the market will come out if they do 50. If they do 25, I think the concern could be that are they being too cautious and not buying enough insurance. So I think it's going to be a tricky week from that standpoint. But I think the most important thing is my assumption and the market's assumption is that they do 100 basis points between now and December in the next three meetings. And therefore, it's going to be 25, 50, 25, or whatever combination. But we're on a rapid rate reduction cycle.
Meetings, or did I hear you say 100?
I'm sorry?
Did you say 100 bips rate cut? Almost like 1% rate cut in the next three meetings is what you're expecting?
That's right. That's right.
Okay. Now that will change a lot of market dynamics, and especially for emerging markets. So if, let's say, interest rates in US, they settle in and around 3 3/4, then that really changes the return dynamics for US bond investors and also for emerging market investors. Are we looking at like a serious serious flow coming back into emerging markets, and where India would get lion's share of it?
Well, clearly it's going to put more risk on. So emerging markets are one of the areas where risk will be put back on. I'm not sure how much India versus the rest of the world, because India has been one of the few places in emerging markets that everybody has been hiding out. Yes, fund flows have not, done well for emerging markets or India. But so I guess India will continue to benefit. But the question is, does it broaden out risk-taking and going into more, riskier markets? I don't know the answer to that. If I were to guess, I think that India remains at the forefront. But I think, risk tolerance, if it improves, maybe people go into some of the riskier emerging markets or, less go-go emerging markets. India is right now the best emerging markets by far. So it will benefit, but incrementally, I think maybe risk-on might cause some of the, rally to broaden into other emerging markets also. But India will get its share.
It's looking good for sure. One of the best performing markets so far, Arvind. But is valuation a big challenge? What's been the latest discussion points around India? Are they okay to pay for the kind of valuations for growth? Or is it now incrementally getting difficult for people to deploy? Because off late, we have seen FI flows come back. Just trying to understand what the way forward is likely to be.
Well, that's exactly the reason why I think if I look at it incrementally, India may get a smaller percentage than other markets because valuation in India have gotten, quite stretched. It doesn't mean that money is not going to flow into India, but it just means that from a relative attractiveness, if I'm going to go after laggard value markets, then India is not at the top of the value screen, right? So in a rate cutting cycle, do markets chase value or do they chase growth? India obviously has the best growth story, but there are other undervalued markets which might get more attention just because of the fact that valuation in India are clearly at the upper end of historical ranges, and there are a few sectors like the banking sector where there is still relative value, but there are other sectors which have become rather expensive.
Okay, Arvind, great to have you on the show. Thank you so much for taking the time out and speaking with us today.
If you like this video, then like, share and subscribe to ET Now.